3-minute trader tip: 7 strategy development considerations. There are many times we may look at the strategies we're currently using as a trader and decide it may be worth adding another. Say for example we have a strategy already that trades a trend reversal. It may be prudent to add one that looks at trading a breakout. This checklist we're going to give you is going to provide a roadmap for putting a new strategy together and adding it to your trading plan. The first consideration of the 7 is to ask the question, what does it add to my trading that isn't already in place? For example, which specific price movement are we trying to take advantage of? Or specific price movement trying to improve from what is there already? We've already given the example of adding a breakout strategy to a trend reversal. We could subsequently add a bounce strategy, a trend continuation strategy, whichever we see as the gap in our current way of trading. In doing this, what we start with is the primary price action on which the entry strategy is based upon. We break that down anatomically by looking at charts and deciding what is the ideal setup that we're seeing with the price action that determines that particular price movement is occurring. So for example, with a breakout trade, it might be that the candle has closed in the top third above a resistance line that we've identified on a chart. The next consideration is to ask the question, what supplemental evidence do I need to increase the likelihood of a higher probability entry? That is, one that is more likely to carry on after that initial movement in the desired direction. And this is where we add our indicators to our trading plan. So we may add to our breakout strategy the idea of there being increased volume, or perhaps the price action is above a 20 moving average. Once we've done that and got our entry criteria set and specific, we start to look at exit. And there are 2 sorts of exit risks that we look at and consider as part of our planning for each strategy that we decide to trade. First of all, is how to manage that initial capital risk, and secondly, how to manage that profit risk once something does start to move in our desired direction. Of course, combined with this is the position size of the trades that we take. Once we've done this, we make a decision on which market vehicles and which market timeframes are you intending to use this strategy. So it may be that you're choosing to trade the major FX pairs on hourly and 30-minute charts only. Now we have our trading plan relating to the strategy starting to take shape. We need to make sure that any statements we use are sufficiently clear and unambiguous to make sure that we can get consistency in action and give us the ability to measure each part of that plan to see how well or otherwise it's working for us. And finally, and assuming that you're already measuring your trading to some degree, we need to ask the question of our strategy and say, well, in light of what we're going to do with this particular trading, is there any additional information I need to record in my journal or the review process that you're using beyond that which I already use? So there you have it. There you have your 7 strategy development considerations. Adhere to these and you're going to be on the right path to developing a strategy that is more likely to work for you going forward. Subject, of course, to continuous refinement and consistent measurement. Trade safe and we'll see you again soon. Bye-bye for now.